Well, good afternoon and welcome to ETFs in Practice. My name is Hamieh and I'm a regional manager at Vanguard, and this is a very timely event. I read an article recently that described the world of today as a VUCA world, one of volatility, uncertainty, complexity and ambiguity. It certainly is a challenging environment for our industry today. For the last few years, we've been supporting clients in an environment that is quite VUCA. And whether it's the political or economic events in China, the US, or Europe, or those closer to home, whether it's reform, disruption, or investor sentiment, we are challenged, and the noise is quite distracting. But with challenge comes opportunity. And even though we've educated our clients well, and we've got the right plan in place, we can still wonder, and we do wonder, whether we're still doing the right thing for our clients. So today, our aim is to cut through the noise, to recalibrate, and to share with you ideas that can hopefully help you achieve better client outcomes and also help you to achieve your business objectives as well. Today's session will be split into two parts. We'll be joined by Rodney Comegys, and Rodney is our head of investments for Asia Pacific. He's been with Vanguard for 20 years, and prior to coming across to Australia 3 years ago, he was head of our index analysis and ETF trading team. He manages a team of 53 investment professionals, and he's well qualified to go through our global economic outlook, the impact it will have on investment returns, but also to delve into ETFs and look at where we are today and what the future holds in that space. Tim Sparks, who heads up our broking and private wealth strategy, will take an even deeper dive into ETFs and put them into action. He'll go through an ETF's due diligence process, but also look at practical case studies that you can use in your portfolios with clients. But before we go any further, let's get you in the right mindset, thinking about business opportunities for you, what your clients are looking for, and what's important to them. So why Vanguard? Why should you work with us? It's no secret that we are one of the largest global wealth managers. We are a trusted and experienced organisation. But why is that important to you and your clients? Well, for a number of reasons. We are an at-cost fund manager, and our unique structure means that we are owned by the end investor. So as we grow, 4.6 trillion Aussie dollars and counting, we're able to pass on the benefits of scale and savings to the end investor in the form of lower MERs. And we believe lowering cost is a key driver for the investment success for clients. ETFs, it's why you're here today. They constitute $750 billion of our total FUM, and 75% of cash flows into Vanguard came into ETFs last year. So they're a key driver of our business growth, and they can also be a driver of your growth too, if they're suitable for your clients. We think we know what clients want. We've got 20 million of them after all. And when we're conducting client surveys, it's like conducting a census in Australia, though I think we run them much more smoothly at Vanguard. But what it enables us to do is capture deep data and get some really good insights into what investors are looking for. And inevitably, that can only help you to help your clients with your relationships. We are a global player, and we have a lot of support on the ground. Again, that's an important reason for you to partner with us. So what are the opportunities that exist for you today? We undertook some research recently with investment trends into the SMSF sector, and there is a great opportunity for you, which you'll find out about shortly. SMSFs, 255,000 of them, have unmet advice needs. They are looking for help with investment selection. They are losing confidence in their own ability to pick investments in this current environment. In fact, 43% of them cited that investment selection was a major gap for them. And who can blame them? They're chasing yield, TD rates are falling, there's a myriad of products coming onto the market, LICs, hybrids, you name it. They need your support. The more concerning statistic is that 3 out of 5 of them are exposed to concentration risk. And I bet you can guess which asset classes they're highly exposed to. Cash and direct equities. And in direct equities, they're mainly exposed to 2 sectors: financials and resources, yes. So there is a compelling opportunity here for all of us to educate our clients on the benefits of diversification. And Tim and Rodney will go through that in more detail shortly. But before you consider opportunities, take a step back and think about your advice model and where it is today, and is it positioned to be able to maximize these opportunities going forward? Costs matter immensely, and the total cost to the end investor is going to directly influence your business sustainability. Think about your advice model today. What fees are you charging your client? What are they paying for investment management? And what are they paying for an administration solution and platform? Here we have a very simplistic traditional advice model. And your model could look like this or a variation of it. It's not right or wrong, it's just an example. The total cost to the end investor today is circa 2.5%. We think this can come down dramatically by introducing ETFs into your portfolio construction process. If lowering costs for your clients and trying to tap into new segments is going to be a priority for you, then ETFs has a major role to play. You can keep your advice fee. You need that for longevity for your businesses. And we've assumed here that the investment administration costs are constant, but with the emergence of new technology providers onto the market and existing platforms improving functionality, this cost is going to drop. So you can save up to 1% by shifting towards ETFs. Now, we're not proposing that you can transform your business overnight to incorporate ETFs into your model. What we are saying is there is a direct reduction in costs to the end investor using ETFs, and we're also here to help you transition towards a model like that. So, it is a very challenging environment, and there is a lot of noise in markets, and I will shortly introduce Rodney to the stage, who will take over and go through some of the noise, but also clarify a way forward. But before I do, you might not know, Rodney used to be a US officer in the Navy, and he worked on I think it was a nuclear submarine, Rodney. So I think with his experience on those nuclear submarines and his experience at Vanguard, he's well placed to navigate through uncharted waters. Please welcome Rodney to the stage.
Thank you, Anne. First of all, for our guests in the back, there are plenty of seats up in front if you would like to. There's seats up here, so come up and join us if you'd like. It's hard for me to imagine it's been 20 years ago that I spent 3.5 years on a nuclear submarine. For those of you who don't know, submarines are uniquely placed in the world. You don't see where you're going. You're in the dark, underwater, and you have to use your sensors, and your sensors is largely sonar. You basically gather data from around to figure out where you're going, where you've been, and what might be your threats out there. In some ways, it's a lot like today's market and economic condition. There's a lot of noise out there, and you have to filter through it. And more importantly, this is what your clients are seeing each and every day. These are the headlines, whether it be the AFR, the Wall Street Journal, or the Financial Times. Deflation, negative, fragile, slowdown. These are scary words and scary phrases for your clients. They need your help in getting them through that period of time. And so if you take, and think through it and think through what is clutter and separate it from what is real when it comes to investments, we think you can be more successful with your clients. So let me tell you what Vanguard's thinking about. This is our global outlook on the markets and the economy. You're going to hear me talk about these four things quite a bit today. It will be a lower growth environment going forward. Ever since the global financial crisis, economies around the world have slowed and really have tried to get their engine going but haven't. Low inflation comes along with it. Lower rates and lower than historical returns. This is what we believe is in front of your clients when it comes to the economy. Just spend a little bit of time talking about a few of the things. The first chart here is every central bank in the world has done this, whether it be the Federal Reserve, the RBA, the Bank of England, or the Bank of China. Rates are at an all-time low across the world. Why? I like to think of it, anyone in this room a cyclist, bicyclist? Few. Everyone's probably seen the cyclist come to a stop at a traffic light. And so the folks with the clips on their pedals, basically what's happened is the economy slowed down, just like a bicyclist hitting the traffic light. But they want to keep just enough forward momentum with the hope of when the light changes going forward. This is what the banks are doing. They're walking this delicate balance of trying to keep their economies moving, but they're really concerned is the same thing as a bicyclist. Anyone who's new to clips on bicycles knows what happens when you come to a complete stop. You fall over. The central banks are worried about deflation. The fact of the matter is, though, that monetary policy has hit its limits. We're 8 years on from the global financial crisis. Rates have been at zero and will continue to be very low going forward. And frankly, it's not enough to get the economies going again. This is a fact. Lower growth is here to stay across the globe. We'll take a deeper look at a few economies. In fact, one of the things I think a little bit about is the following scenario. If 5 years ago I said to you, hey, buy a bond from me, pay par for it, or give me $100, and we were to wait 5 years and I were to return to you $98, we had a term for that. That was called a bond default. Today we call it negative rates. That's how desperate Japan, Switzerland, and a couple of other European economies are to get money flowing again and growth going. There's even new terms that haven't even been invented yet, helicopter money in Japan. This is the new reality, folks, and something your clients are going to experience and are going to have to deal with. The second thing out in the headlines is something we're paying attention to. I really think it has some implications, which is income inequality. The left-hand chart is Australia, where the top 1% of income earners, this is how much of the proportion of total income they get. If you look back, it's just continued to grow. The rich are getting richer or more wealthy, and the middle class and the lower middle class are falling behind. Same phenomena on the other side of the chart. This is the US. Throughout the 2000s, 7% of real income has been lost by the middle class and the lower middle class of America. This has some implications. It's coming out, and it's coming out in political and market uncertainty. Amazing, these three pictures. The one in the UK, the citizens largely outside of London didn't feel they were getting their fair shake and voted to leave the European Union. A very successful monetary and political union there. It's amazing change we're seeing. I, as an American, have learned a new term. I had no idea what a hung parliament was until a few weeks ago. Didn't quite get there, but at least I've learned something. But clearly, Australians were not feeling included and chose a particular side of a political world. My home country of America, probably the most interesting. Americans are feeling left out, have created a new term for us, Trump. I'll leave it at that for politics. However, while this is in the headlines, let's not overreact to the news. The blue bars here represent what happened on the day of Brexit, a real surprise, at least if you looked at the bookies and the betting side of the house and the predictors in the newspaper. The world was surprised. When the world's surprised, equity markets tend to go down. They went down globally about 4%. Flight to quality, so prices of bonds go up, rates go down. Don't have to wait very long, though. 3 weeks later, the market has largely returned those equity losses, and the bond market has settled down. You have to help your clients tune that out. Keep in mind that they're investing for the long run. And what leads and drives equity returns? It's not the political or the economic environment. It's 10,000 global companies each and every day trying to make a profit for their shareholders and grow their economic success and engine. It's a long game investing, not a short game. You have to turn out the noise. So if those are two things that are really interesting but we don't think are all that relevant to the economy, or at least that meaningful, what are we thinking about and what are we keeping our eye on? Many of you were here 6 months ago when Hamieh Wang, our Chinese economist based in Hong Kong, went deep on China. I'm going to cover it in one slide. China's slowing down. After 20 years of double-digit growth and success as we went from emerging towards the developed world, China is going slower. Published headline rates, 7%. I think we need some accounting checks on that. We would believe it's probably closer to 5 or 6% for China growth. That's our base case. That's actually what we believe in. We believe China has both the money and the policy and the determination to rebalance their economy from one that was heavily infrastructure building dependent and manufacturing dependent to much more of a service economy. It will be a sustained slowdown, but we think they can handle it. So that's our base case. Even if China misses, they have enough excess in their economy to deal with small misses, and there will be and have been policy misses. It is a transformation and a difficult one that will take many years to come. Only in the extreme scenario of a real Chinese recession would we see impact on the rest of the globe. And again, we think that's highly unlikely in our scenario planning, given the current conditions in China. But it is something we must keep our eye on. It's also going to matter. China will enter the world's, or the China A shares will enter the world's market in the coming years. They will be a part of your investor's portfolio, which will cause questions. I've been fortunate enough to work for the last couple of years of helping Vanguard prepare with regulators and exchanges in China for just such a transformation. It will be the world's second largest stock market when it enters, and eventually it may even be larger than the United States over time. This slide I feel really great about. Why? Because over the weekend, the Federal Reserve governors, met in Jackson Hole. And they solidify what we have on this slide. Vanguard's belief is that it will likely be a 25 basis point increase by the end of the year with regard to interest rates, and probably 50 basis points of increase within a 12-month period of time. It's effectively what was signaled by the Fed. You know, we never know till it actually happens. It's all a probability game. But why? Why can the Fed raise rates? Full employment in the United States, a very healthy economy with domestic strength, a little bit of inflation starting to show up, and very strong consumer spending in the United States. The U.S. economy is going well. Before we get too excited, the Fed's likely going to take a long time to really raise rates to a meaningful level, and will cap out at probably about 2%. Low rates are here to stay, even in the United States where an economy is going well. There also is some caution for the Fed, worrying about Brexit, China, and probably as much as anything, currency. When rates rise, often FX goes with it, and the U.S. needs to export. It's an exporting-driven economy and wants to continue to be able to do so. That's our view on the U.S. economy. Let's just turn our attention a little bit more locally for our views on Australia. Rates here are at an all-time low. We would think they will continue to go lower. The Australian economy is in transition also. Post-2008, commodities, and specifically iron ore prices, as commodities were exported to China for consumption, really drove a positive economic story, and one of the rare ones here in Australia compared to the rest of the globe post-2008. Those days are over. China's consumption continues to lower, and iron ore prices will probably remain closer to a low than an all-time high. What does this mean? This means one of the key industries is shrinking and changing at all the time. There are some good highlights in the Australian economy. 3 industries I would just point at. Agriculture, high quality fruits, vegetables, and meat for export to the rest of the world, largely China for consumption. Great story. Education, high quality, world-class secondary education here in Australia for the citizens of the world to take advantage of. And finally, tourism. The lower Australian dollar means more people are capable of visiting, and Australians are staying home. Unfortunately, those 3 industries aren't as large as what's been lost in commodities, and they also bring largely part-time or lower wage jobs in relative comparison to that of the commodity sector. At this point, we'd suggest for Australia, one of the things about low rates makes possible is the potential for reinvesting. Low rates at a historical low may mean it's a great time to build new infrastructure to help Australia for the next 50 years. Really something can be learned for all economies at this rate. Hopefully businesses also start to invest and take advantage of all-time lows. Get that economy going again. And for Australia, probably a need to concentrate in areas such as venture capital and private businesses to develop new industries and new technologies to make Australia great in a few areas. The other area we keep our eye on is housing here in Australia. I had the unfortunate pleasure of living in Arizona through 2008. For any of you who don't know, Arizona was one of the places hit hardest by a housing bubble. I lived through it. I bought a house around $300,000, which within 2 years was worth $800,000. Within a few years, it was back to $300,000. I lived through a housing bubble. I can't predict one. I can't predict whether Sydney or Melbourne are in a bubble. We do know the froth is off the top in Perth, largely driven by those job losses in the commodity space. Don't know. I probably can predict, though, that the continued housing price appreciation that you see in the chart will not continue. Something very interesting with consequences here in Australia, depending on what happens, largely in Sydney and Melbourne. Something else we think a lot about. So just to sum up our view on the economy across the world, Australia is a bit vulnerable, as new industries are needed to replace what's been lost in commodities. The U.S. can go through some growth scares. Every time you see a surprise number, a manufacturing number a little bit less than what was expected, or an employment number that's not as strong, the market will react with volatility. We do think the U.S. economy is pretty strong, and we'll get through that. So again, tuning out that short-term noise is important. Brexit just brings uncertainty to Europe. It's going to take a decade to figure out what it means and how the UK will interact with their neighbors. I haven't mentioned Japan. I think we're being generous here with stuck in second gear. Japan's issues can't be solved by simply monetary or fiscal policies. An aging population and shrinking demographics is a tough place to be. Japan, we've already talked about a sustained slowdown, the future of China. While it looks fragile, don't lose hope for the future. So what does this mean to your clients? I want to share a story with you. 2 Sundays ago, I'm sitting in my living room, and I get a text from a coworker, a very smart woman who works in our Pennsylvania office in our equity team. And she says, I'm mad, or I think it was actually, I'm annoyed. Like, coworker, I hope I didn't annoy her. I'm not quite sure, so I responded back, what are you annoyed about? It turned out it wasn't me. It was her 401k returns. A 401k is the equivalent of superannuation for Americans. She had been looking at her historical returns and was disappointed, I think was the best way to put it. And we went back and forth about the number, and I said, what were your expectations? What were you thinking should have occurred? She said 10%. I said 10% return. It's amazing. What do you think is going to happen going forward? We didn't spend much time on it, but why does she think 10%? It's a Stanford-trained MBA who works in a financial services company, plain and simply because that's what's happened. If you look over the last 30 years, I got Australian data here, global data is pretty good too. 10% in the shares market has been what the markets have delivered. 9% for bonds, incredible time the last 30 years. Cash, 7%. I can guarantee one thing, that won't be occurring for the next decade. Some inflation at 3.2%. These are the facts. This is what we have in our brains. And more importantly, it's probably what your clients have in their head going forward. These are the expectations you have to manage going forward. So what do we think is going to happen? We have a team of about 20 economists who do a capital markets model. And the capital markets model does about 10,000 simulations, takes the current inputs of the economy and blends them together and gives you our thing. Very cautious here. These are point forecasts. Our actual model, if you read our paper, would be a spread of outcomes. They could be better. They could be worse. These are just the central tendencies of the model. We need to reset our clients' expectations lower. 6 to 8% for equities. Pretty good still, but not what's historically been achieved by the market. Bond market, 2 to 3% for bonds, providing that ballast in a portfolio for downtimes. I actually think we're a little generous at 2 to 3% cash. It might not be achievable. The only good news about this is inflation. We believe it's going to stay lower. And that's good news because those returns above won't be eaten away by inflation quite as much. The nominal returns turn into more real return left for the end investor. What does this mean when you put it together into a well-diversified portfolio? Not bad. 7, 6, 4%, depending on your stock-bond mix. Investing is still a great place for your clients and probably the best choice they have for generating wealth, for generating what they need for retirement, funding their hopes and their dreams. We still think this is a great way to go forward. It's just going to be different. Lower returns than historical in a lower growth environment. So I've talked about lower growth, lower rates, lower returns, and probably some lower inflation. This is why we really think it's the ETFs should work for your portfolio. They'll help you put in play a disciplined approach and help with diversification. Tim will talk about some of those details. Before I do that, though, I want to talk about some macro trends. Pivot a little bit here to exchange-traded funds. This is an incredible slide. The world has 6,000 ETFs, 4 trillion of assets under management, and I think the one on the far right-hand side is probably the most interesting. 2 times growth. The ETFs in the world will double in assets by 2020, 3 to 4 years from now. ETFs are here to stay and a big part of the portfolio. It's pretty good for a vehicle that really came about around 1991 with the creation of State Street's SPDR product in the United States covering the S&P 500. It's an incredible change in our industry and our business. I would put up a slide right now that said who's using ETFs, but the truth of the matter is everyone's using them. If you were to look at US ETF, which is probably the most developed ETF market, and you were to look on Bloomberg at the holdings of our exchange-traded funds, who would you see? You'd see hedge funds such as Bridgewater Investments, a very successful hedge fund holding ETFs. You'd see pension funds. You'd see the Harvard Endowment. You'd see life insurance companies. You'd see mutual funds getting their beta exposure using exchange-traded funds. You'd see a lot of folks like yourselves, financial advisors who have changed their practice from one that was driven by commissions to one that now wraps generally a low-cost product in exchange-traded funds. And finally, the retail investor, mom and dad. Everyone is using ETFs. I've been fortunate enough to work in 5 countries on the launch of products, the United States, Canada, the UK, Hong Kong, and here in Australia. This is a similar story. Each market's in a different set of development. Originally, Europe, ETF story was one of insurance companies got a less of a haircut if they use an exchange-traded fund. But more and more, with fee reform for advisors, you're seeing ETFs used there and in retail. Let's take a little closer look to home at the trends in ETFs, or at least the stats. 137 ETFs on the ASX. Last night, there was a celebration at the ASX, 15 years since the first exchange-traded fund in Australia. I got here 2.5 years ago. The industry had 10 billion in assets, 22 billion. And I think the coolest stat here is a 37% growth rate in the use of ETFs by some trend work done by Investor Trends. ETFs are here. The story of who's using them in Australia is a little more narrow. Thank you to all of you in the audience for your use of ETFs. Thank you for your business for Vanguard. We really appreciate it. We think it's a great way to go forward. You were the heart of the start of ETFs. You, along with self-managed super investors who were looking for low cost and more diversification from the traditional super option. They were the start. What's happened in the last year, though, we are seeing institutions here in Australia use ETFs more and more. So it's not as much just a retail game anymore. It's starting to change. And that's generally what we see across the world is there's usually somebody who uses the exchange-traded fund early before it's expanded out to more investor usage. So why? Why have ETFs gotten to be 6,000 of them, 4 trillion of them globally? We would argue there's two things. First, the majority of exchange-traded funds, about 90% of them, are what would be classified as some type of a traditional index product against a broad-based benchmark giving an index return. About 10% of those are something else, which we'll talk a little bit more about. They're also there because of low fees. So for 20 years here in Australia, Vanguard's been telling this story. This is how index funds are performing against active funds in the universe. And just a basic refresher, why do index funds do so well? Half of the investors in the world should do better than the index, and half the investors in the world should do worse than the index. That works up until you put costs in the equation. As soon as you put the higher price of active fund management into the equation, indexing starts to do better. It starts to be 60, 70% of the market. A little time period dependent, a little bit asset class dependent, but indexing by definition is going to do better than average because of the cost advantage. That's the story most of us remember. The second part of the story about indexing, I think, is interesting. It's very hard to predict which active funds are going to outperform the index. Just as hard as will they remain there. That's why indexing works. We don't know what active funds are going to do. Before you believe Vanguard's only about indexing, keep in mind our history, and we still have $500 billion of equity active funds out of our US business. We believe in active. We believe some managers have the skills and ability to outperform the index. We just believe you can't destroy their alpha with high costs. So we offer low-cost active products with a chance of outperformance using 20 different external sub-advisors and our bonds done in-house, along with some quantitative work done in-house at Vanguard. We do believe in active. It's just very hard to do. This is a simple cost chart. Cost matters. This is an investor, Dan, 25 years old, just keeps plopping $5,000 in the market year after year, and he has two choices. Choice one is a managed fund at 115 basis points. Choice two, the average ETF at 48 basis points. If he lives to age 70, he's got $175,000 extra dollars in his account on cost alone. Cost matters, and generally ETFs are cheaper. By the way, you won't find much in our lineup at 48 basis points, substantially cheaper across the board, even giving you more chance for longer lasting returns in your portfolio. That said, let's be a little cautious about exchange-traded funds. Let's be realistic about it. The world probably does not need 6,000 different exchange-traded funds. Where there's commercial success and $4 trillion of assets growing to $8 trillion by 2020, there is and will be product proliferation. There aren't that many new inventions in finance. Most of what comes in finance is about marketing of something new. I'll pick on one, which is smart beta. Smart beta to us is neither smart nor beta. Smart would imply that it's better, it's going to outperform. No, it's going to perform differently. At times it will perform better than the index, times it will perform worse. What is smart beta? It's generally a group of stocks that are classified together based on common characteristics. Often, many of the early ones were a small value. That's going to perform different than the index. Not necessarily better, not necessarily worse, just different. So it's neither beta nor smart. There will be and continue to be product proliferation. Don't get me wrong, smart beta or factors can be terrific for your clients' portfolios. If you're a shop that believes in small cap value and that's where you want your client positioned, you may use ETFs to do so. You may use market cap, you may use factor products. It's okay, it can be a proper use. Second thing is, imagine if you're a shop that really wants a value tilt, and your choices are a 200 basis point value manager or a low-cost factor ETF. You may change and use that tool in your toolkit. ETFs and product proliferation can be good, but you're going to have to go do the homework. There's a lot of noise to cut through when it comes to it. We'd also say there's no alchemy. There's no way that with risk, with the opportunity for returns, you don't get risk. There's a chart we put together. It's a little bit hard to read, but the short version is it's basically the classic trade-off. Where there's a potential for a return, positive and negative, there comes with it more volatility or more risk. Down in the left-hand corner, it's just ETFs that are invested in T-bills or treasury-type products versus things that take a more aggressive approach to security selection. There's no free lunch in finance, and ETFs haven't found that. They just organize themselves and their securities in a way that gives you a form of an active return. So just to sum it up for today, we see a low-growth environment going forward with lower rates as the world's central banks try to get the economies going again and keep forward momentum. We've all got a difficult job to educate our clients about lower return expectations. Lower inflation will help a bit with that. And we do think ETFs can be a great tool to help your clients achieve what they're after, which is great investment returns for their future and their dreams. Tim, you want to come and talk about some of the usage?
Thank you very much, Rodney. Well, thank you very much, Rodney, for that really insightful look into the local and the global economy. And thank you to all of you for coming as well with a lot of familiar faces and then a lot of new faces as well, taking time out of your busy schedules to hear a little bit more about exchange-traded funds. And as we heard, Brexit, the US elections in November, we've got the French elections coming up in March of next year. The resurgence of the political economy has never been more important to manage market risk and then also asset class risk, and we're seeing ETFs being increasingly used to do that. And so in order for ETFs to be used in client portfolios, advisors need to be comfortable with three things. Firstly, you need to believe that the ETF is going to deliver the market risk that you're looking for. Secondly, with over 130 on the ASX alone, for those of you who find it easy to execute on offshore exchanges, there's over 6,000 worldwide. How do you select which ones to use? And we'll have a look at a due diligence process, some of the important things. Thirdly, when you go to pick up the phone to have the conversation with your client about that selected exposure, what sort of things are you looking to say? And the packs that you've got in front of us today, we've built those with that in mind. So we haven't just provided information for you as advisors and brokers, but then also information that will help educate your clients as well. So Rodney talked a lot about risk. I'll carry that thematic through for the next 25 minutes or so as we implement the benefits of diversification into some practical examples, portfolios. And I'll start off with the foundation of capitalism, which is the theory of creative destruction. Joseph Schumpeter, an economist in 1942, argued that when you introduce new processes, technology, products into a market, existing processes, products and technology become obsolete. And so when we introduced the $1 and $2 coin, we had to say goodbye to the $1 and $2 note. And as we start to use tap and go technology over the next sort of 5 years or so, we'll start to see less and less of real money itself. ETFs are newer technology, there's no doubt about that, but we very rarely see them being used in isolation. We always see them being used in conjunction with other investment vehicles. So whether it's direct stocks or managed funds, where we are seeing innovation is within the advice model itself. And so the traditional investment advisor that was focused on outperformance, on picking winners, on market timing, which, as you know, even with a large research team is very difficult to do year on year, we're seeing that moving over for the strategic advisor. So a focus on asset allocation, on portfolio construction, and most importantly, guiding behavioural coaching clients towards their long-term investment objectives. And we're seeing ETFs being used more and more within that strategic advice model. And that's whether it's here in Sydney or across Australia, the Asia-Pac region, across Europe and the US. That's something that's driving exchange-traded funds growth globally. So if you feel that ETFs have a place in client portfolios, what sort of things should we look at when we're selecting a particular exposure? And the first thing we should be looking at is the provider. So is the provider an entity that's experienced with dealing with the ETF ecosystem? And by that I mean with index providers, with global exchanges around the world, and then also with market regulators, not just ASIC but the SEC. Second thing we look at is what's their support model? So do they have local business development managers that can get you answers to your questions quickly and accurately, or is their service model simply via a website? Second thing we need to look at is the structure of that exchange-traded fund. You may find it interesting to note that 90% of global ETF assets under management are physically backed, fully replicated ETFs over stocks and bonds. And so with that comes the benefits of that product category that has made it so popular: cost-effective, diversified, transparent, liquid, tax-effective exposure. In contrast to that, leveraged and inverse ETFs, whilst they get a lot of press, only make up about 1.5% of global assets under management. So leveraged and inverse ETFs, at Vanguard we don't construct them, and the reason for that is that in some market conditions they simply don't work. The third thing we need to look at is liquidity. There's two sources of liquidity within an exchange-traded fund. The first source is on the exchange itself, so the trading of the ETF on exchange, and the second source is the liquidity of the underlying constituents that ETF is tracking. Sorry, the liquidity of the underlying constituents that's using the benchmark that ETF is tracking. And so we need to look at two sources, firstly on exchange, but then also the liquidity of the underlying constituents of the index. So three things to look at, and some pointed questions there to ask of your ETF provider. Rodney spoke a lot about costs and showed the power of keeping costs low over an extended period of time. And what we've got here is just a really simple framework for you to compare certain ETFs. And we've got two costs within this. Firstly is the MER, so the management expense ratio, and the second is also the buy-sell spread. When you're looking at a spread, look at that in the context of getting that type of exposure by some other investment vehicle. So you might be looking at a managed fund, and you can see that 11.5 basis points or 10 basis points starts to look pretty competitive. VGS, which is Global Developed Market Exposure, and I've compared that to a competitor ETF which is sold as a proxy for Global Developed Markets. VGS is putting a wrapper around 1,500 stocks across 20 global developed markets, and so when you're looking at a spread of 11.5 basis points, that would be a lot more cost effective than buying those underlying constituents, and the ETF starts to look pretty competitive. The last thing that I'll say on costs is that keep in mind your client's investment horizon, because if you're choosing an 18 basis point MER relative to a 40 basis point MER, that 22 basis point saving for what might be very similar exposures is something that's going to add up over time. So a really simple way to analyse costs, and we produce that data every week, and we're more than happy to share that with you. So moving from due diligence over to solution mode, what we see out in the market, three pretty common uses for exchange-traded funds, and we'll build out some thematic exposures, we'll construct some asset classes, and then we'll look at holistic portfolio construction using exchange-traded funds. So firstly, taking a look at thematic ETF trading, as we go around the world in three trades, a really popular trade in the Australian market over the last 2 years has been to trade into US equities. So on bullish US equities and on bearish the Aussie dollar versus the US dollar, and VTS has been a really good way to play that. VTS contains over 3,600 individual US listed securities. The ETF is putting a wrapper around that and allowing you to trade that with the convenience of ASX execution. It covers 99.5% of the US equity market. The S&P 500 only covers about 80%, and we've seen that trade go pretty well over the last 2 years. VEQ, trading into broad market developed Europe, getting access to economies such as the UK, Germany, Switzerland and France, building out exposures that aren't readily available on the Australian Stock Exchange. And the last region we've got there is VAE. So that's 10 countries across regional Asia, giving you access to companies like China Mobile, Samsung and Taiwan Semiconductors, building out GIC sectors and exposures that are, again, poorly represented on the Australian market. So trading into the US, Europe, Asia in isolation is something that we see as a really common use for exchange-traded funds. Alternatively, you can use those three trades to build out your international equity exposure. And so you can take a view that there may be some growth opportunities in the US relative to Europe. I'm a little bit worried about the volatility over there, so I'll overweight the US equity market. VAE, the Asian region, a lot of emerging market economies in there. Have they been oversold over the last 2 years, and are there some growth opportunities, and so you might want to dial up that exposure. You can use them with flexibility and control, something that's driving ETF usage across the planet, to suit your particular view. And here is where we're starting to see what is essentially a passive investment tool being used in a very active way. So I'll move from thematic portfolio construction over to asset class solutions, and this is the first of 2 case studies today. I'd like you to meet John and Eleanor. John and Eleanor, mid-50s, 2-income family. Current portfolio is composed of Australian equities and cash, and the research that we're getting suggests there's a lot of portfolios out there that has that kind of concentration risk. Anne spoke about that. They're aiming to maximise their savings pre-retirement, and they're looking for professional investment advice. And more often than not, we see the solution start with the implementation of an international equity portfolio. So what we're going to use is global developed markets and global emerging markets. Now, quite often we see clients just using VGS, so 20 global developed markets, and that's the core component of that asset class. But we think that there's pretty good, there's room in a international equity portfolio for emerging markets as well. So if the client had $100,000 and they put $90,000 into VGS and $10,000 into VGE, they'd get a very strong correlation to a popular international equity benchmark. So any active fund manager that's picking all the best stocks around the world will more often than not benchmark themselves to MSCI ACWI, and now you can build that with 2 ETF trades. The performance of MSCI ACWI over the last 10 years, as we've come into the global financial crisis, muted currency returns from the commodity boom, around about the end of 2013, we were asked to come out and present on international equities in pretty much every presentation we were asked to give. And the reason for that was that it was up 25%. So if you put international equities into a highly concentrated Australian equity portfolio, because of performance, if it doesn't go that well next year, in terms of what it's done historically, that could cause a difficult conversation with the client. What's really important, I think, to cover off in the conversation is that whilst performance is very important, it only tells half the story. And what I'm doing here is I'm starting off with an Australian large cap portfolio. So VLC is an ETF, a large cap ETF that we have on the ASX. And essentially it's the largest 30 stocks by market cap in Australian equities. And the reason I'm using that is because it probably broadly represents a lot of Australian equity portfolios that we see. The volatility of that portfolio coming in at 14.5% is broadly representative of the Australian market. And when we add in the international equity portfolio, one of the major benefits of ETFs starts to come to the floor, and that's the benefits of diversification, because within those 2 trades, we're adding in over 5,500 individual securities across 40 developed and emerging market economies. And so what that does is it brings portfolio volatility down by about 24%, giving clients access to industries and companies and GIC sectors that are poorly represented on the Australian market. And you're also giving yourselves the flexibility to swap out that unhedged exposure, swap in hedged exposure, exact same exposure in the form of VGAD if you want to, and give yourselves the flexibility and control to dial up or dial down the developed market exposure versus the emerging market exposure if you think that, well, emerging markets have underperformed developed markets by 14% for the last 2 years. Is there a buying opportunity, and do I want to overweight that? That's the flexibility and control that starts to come through. And a pretty good result, because if the client is having the same expectations of returns, your expectations of asset class returns going forward, and they're doing that with a lower volatility levels and a smoother ride, that means easier conversations for you during times of severe market dislocation. So let's move on 5 years. I've used the same photo, but you'll have to believe me when I say they're in their early 60s now. One income, current portfolios composed of Australian equities, international equities, we've added that, and then also cash. And they're looking for professional advice on international fixed income. So I'm going to build out this solution in exactly the same framework as I did international equities. We're using 2 ETFs, international fixed interest in VIF. Quite often we see that just being used as the core component of international fixed income, but we think that there's room for credit securities, international credit securities in portfolios too. So if the client had $100,000 and $65,000 goes into VIF and then $35,000 goes into VCF, they get a strong correlation to a popular international fixed income benchmark, which is Barclays Global Ag. 10-year performance from 2006 to 2016, and this is where it's more important than ever to heed the information that Rodney gave us on expectations of asset class returns going forward, not relative to what we've seen in the past 30 years. But let's have a look at this from a risk and return perspective. I'm just going to recap where we started from. 30 of the largest stocks on the ASX, that was our original portfolio. We added in international equities, and now we're adding in international fixed income. And I'm sorry if I've thrown a lot of acronyms at you in the last 15 minutes. This is the last one. We're also going to build out a 30% exposure to income assets with domestic fixed income exposure. Okay? So international fixed income, domestic, and this starts to look like a risk profile of a growth portfolio where you've got 30% of the assets in income and you've got 70% of the assets in growth. The analysis of the risk and return profile, where we started 30 of the largest stocks, 14, we brought that down 25%. Now adding in fixed income, we're lowering the level of volatility within the portfolio by 50%. In 5 trades, we've added in over 10,000 stocks and bonds across more than 40 developed and emerging market economies. And here's the power of exchange-traded funds. You've got the flexibility and control to do that. And I won't lend too much time to the increase in performance that the client would have got, because it's easy for me to build good portfolio returns in hindsight. But regardless of what happens going forward, in your views on asset classes and portfolio construction, that volatility levels are much easier to predict than asset class returns, and that lower volatility will flow through. Again, easier conversations with your clients during times of severe market dislocation. The last case study for today, Sam, early 40s, 280K in super, invested in stocks and cash, wants low-cost investment, seeking advice on a range of asset classes. So it's an interesting challenge for Sam, because whilst $280,000 is a significant amount of money, is it enough for Sam to be a profitable client within your business? And so we start to need to entertain scalable solutions that are going to provide good outcomes for Sam, but then also capture that next wave of clients looking for advice. So I'm going to talk quickly about our diversified managed funds, and the economic analysis that Rodney went through is powered by a proprietary simulation engine called the Vanguard Capital Markets Model. That model produces our outlook and commentary that we take out to market, but it also incorporates a model that comes up with the strategic asset allocation or asset class weightings within our diversified funds, managed funds that we offer out to the market. And the performance has been fantastic. implementing strategic asset allocation with a very sophisticated research team, low-cost investment vehicles in terms of implementation, and the performance over each time period and across the 4 growth profiles has been significant. I saw a Morningstar report yesterday where half of those dots are actually top 5th percentile. And the reason why I'm talking about diversified managed funds is because you can build those with ETFs too. So since we listed international fixed income, you can build out each of those asset classes, and what a great solution for Sam. Here we've got the income assets, the growth assets, a very sophisticated model portfolio, and implementation by simple ASX execution with 7 trades. And Sam's getting access to over 11,500 stocks and bonds in those trades. And if you think back to early 2000s when this notion of diversification used to be, say, 20 stocks across 10 different GIC sectors, the technology is now available to you on the ASX to build something significantly different. What I would encourage you and your clients is to not mistake simplicity with lack of sophistication. There's a huge amount going into the asset classes, and then also the delivery of these low-cost investment vehicles. And Sam's getting that result for 13 basis points. So Rodney ran a simulation on Dan, $170,000 more by keeping the costs from 110 basis points down to 50. Well, if your clients are currently investing at 110 basis points and you can bring it down to 13 on $1 million portfolio over 10 years, that's a pretty significant improvement. That's a concept that we call Advisors Alpha, keeping costs low, keeping more money in the portfolios over a long period of time. That's the high growth portfolio. We've also got the other risk profiles, and those risk profiles and some commentary around that are in the packs that you've got. So what does it mean? Well, as fund managers, we're obsessed with the efficient frontier, and you're moving clients closer to the efficient frontier where they're getting an appropriate amount of return for the minimum amount of risk. Simple yet sophisticated, and also genuine diversification. What does it mean for you? There's less time picking winners, market timing, moving over towards that strategic investment advice where you're focusing on asset allocation, portfolio construction, wealth management, and also customised risk and return analysis. So what do I mean by that? We all get the modern portfolio theory, but sometimes what's difficult for advisors and brokers is that how do you customise that for a client, especially a self-managed super fund client, where they're their own investment managers. They always think they're doing a good job, but how can you say, well, actually, you are taking on more risk than the broader market, and the returns haven't been as good? Now, I wouldn't pose the question if I didn't think I had a solution. What has worked very well in the US, and we're seeing a large take-up of this resource down in Australia, is it's a portfolio modelling tool. It's powered by Morningstar data and allows you to take your client's portfolio, whether it's an existing client or a prospective client, load it up into this engine, look at the risk and return profile of the existing portfolio, and then compare it to the investments that you'd like to layer in. It doesn't have to be Vanguard ETFs, it can be any managed fund, direct stock or ETF on the Australian market. And so the output is 7 pages of analysis that you can choose to show your clients as much or as little as you want, depending on their level of sophistication or the level of education that they have. The output is from you. It's not branded Vanguard, it's from you to the advisor, and we're seeing that that customised analysis can really help complement your already robust advice processes. And I'd encourage you to log on to the internet and reach out to us for a training session. So just in finishing, we've got 17 ETFs on the ASX across the asset classes, fixed income, property, Australian shares, and international equities. That has been a theme for today, and we're giving you the flexibility and control to dial up and dial down exposures. If you want broad market, regional exposure, low cost, hedged, unhedged, if you want to develop versus emerging, and also low administration. The research that we're doing is telling us that clients and you don't like filling out W8 Ben forms. The vast majority of our international equity ETF product set, you don't need to do that. So with that, I'll finish by saying that adopting ETFs within portfolios or looking for new ones to use or changing particular exposures, there's a decision tree there and it's a journey. And we have the largest ETF, BDM and BDC support team in Australia. Many of them are in the room here today, and I'd encourage you to reach out to us because we'd love the opportunity to go on that journey with you. So with that, I'll thank you very much for your time, and I'll hand over to Anne. Thank you.
Thank you, Tim. And there's no doubt that the ETF space is going to continue to grow. And as Rodney mentioned, FUM in ETFs could probably double by 2020. So just in closing today's session, we've heard a lot from Rodney and Tim, but the clear message is to maintain your focus on your clients and to keep it simple. I think they've both convinced us that ETFs are here to stay. And don't get confused by all the noise. What's important is to think about your business model and how can you incorporate ETFs into that and what's important to your clients. Tim talked about thinking globally and acting locally and went through a number of case studies that really focus on diversification and some clear portfolio strategies that can help you with specific clients to diversify risk away. As you know, we are a strong believer in asset allocation, and we think it's a key driver for investment returns. Whether your view is strategic or tactical, let asset allocation do the hard work and use ETFs to implement in a simple and cost-effective way to those asset classes. Now more than ever, your clients need you to be a behavioural coach because that's where you can add value and truly support them in these VUCA times, as I mentioned earlier. So Tim and Rodney will be at the front of the stage if you do have any questions. Please complete your feedback forms because your feedback is valuable to us. Thank you again for your time and have a good afternoon.